Good morning, students. Today we are going to discuss about the topic from partnership accounting in Garner versus Morere rule. Discuss about the meaning of Garner versus Morere rule and applicability, rules, examples and importance of this rule. First, meaning of rule. What is Garner versus Morere rule? It is the principle used in partnership accounting when a partner becomes insolvent. When the partner unable to pay his debt during the dissolution of partnership firm. So in that time, this rule will be applicable. So that means insolvent means unable to pay his debt. Next is how to this rule followed. The rule is based on the English court case called Garner versus Morere. It is in 1894. According to this rule, if a partner becomes insolvent and cannot pay the deficit in his capital account, the loss caused by insolvency must be shared by the solvent partners in his capital ratio. So this is the rule, importance of rule. Next is when this rule is applicable. The partnership firm is dissolved and one partner become insolvent. Insolvent partner cannot pay capital deficiency. No agreement in partnership deed. Last agreed capital can be determined. So this rule applicable only in this special situations only, not for all the situation. Suppose the solvent partner can pay the debt. That means this rule not applicable for this situation. For example, Mr. Alex and Mr. Balu and Mr. Charlie have a partnership in partnership firm. Let us one of the partner of this partner, that means Mr. Charles, become insolvent during the dissolution of the firm. He cannot pay rupees 30,000 due from his capital account. So in this situation, the other partner, that means the solvent partners, should pay the debt of insolvent partner Charles. Alex and Balu compulsory pay the debt for Charles. According to this Garner versus Morere rule, Alex and Balu will bear the Charles deficiencies according to their last agreed capital ratio, not for profit sharing ratio. Only solvent partners bear the insolvent partners deficiency. The loss is shared according to the solvent partners in his last agreed ratio. Deficiencies shared between the solvent partners in the agreed capital ratio. The last agreed capital means capital after adjustment like reserves, profit and loss and drawings, interest on capital, salaries and any other commissions, but before realization loss. So if the partnership deed already contain a method of sharing insolvency loss, the agreement will be followed instead of Garner versus Morero. In this situation, the rule will not be followed. The agreement will be followed. how to contribute the ratios for the solvent partners to the insolvent partners' debt. The rule is mainly applicable when the dissolution of partnership firm, one of the partner is insolvent, they have some capital deficiencies, the contribution of insolvency not mentioned in the partnership deed. In this situation, it is not applicable. In this rule will not applicable for one partner is admit in the partnership firm, one partner is retired from that partnership firm, and any other death of the partner or any other ordinary business transactions, this rule will not be applicable. Why this rule is important, needed? That means there is lot of confusions created when the insolvent partner does not pay the deficiency in his deficiencies. In that situation, who is bear the losses? So the Garner versus Morere rule solved this problem by clearly stating the solvent partner should bear the loss in their agreed capital ratio. So benefit of the rule means it is help to avoid the conflict among the partners become the critical situations and ensure the fair sharing of losses and remove the confusions in the time of dissolution of accounting. To give some exception of this rule, partnership deed mentioned any other method to contribution of insolvent partners deficiency means in this rule not applicable, and all the partners are insolvent, that means in this rule that not applicable, and no capital deficiency exceed means this Garner versus Morere rule is not applicable for that time. The final conclusion. To conclude, the Garner versus Morere rule state that during dissolution, if a partner become insolvent and cannot pay his capital deficiency, the loss is borne by the solvent partners in their last agreed capital ratio. This rule ensures fairness and avoid the disputes among the partners. Thank you.